The Canadian banks are in serious trouble as the housing bubble, which was the biggest game in town, is now imploding. Investors are taking hundreds of thousands of dollars worth of losses, and the risk of these mortgages going bad is just increasing and increasing on the bank's balance sheet. So big five banks back most of Toronto's negative cash flow condo investors, and we're also going to get onto another massive loss, $320,000 loss on a condo. We'll get into that in a minute. So Canada's banks have dominated Greater Toronto's investor mortgage market. CIBC data shows the Big Five captured 75% of investor mortgages on condos completed in Toronto in 2023. There's just one problem. Most of those mortgages are cash flow negative. The rent fails to match the payment, property taxes, and maintenance fees on the unit. The Big Five are increasingly backing mortgages on assets with falling prices and negative cash flow. And the other thing you've got to think about, which we think about on this channel, is how's that renter doing? How is the renter doing right now when you've got rent inflation that's at the highest level since the 1950s? The renters aren't doing particularly great, are they? Because if their rent increases faster than their income, obviously their budget is getting more and more compressed. We're seeing credit card debt skyrocketing. We're seeing more and more people pulling on lines of credit. There are signs of distress that are absolutely everywhere. More personal bankruptcies, also corporate bankruptcies. You've got more people doing debt consolidations, and you've got more people just outright defaulting on payments. So yeah, you can have a cash flow negative condo in Toronto, but just bear in mind your other risk is that you have nobody paying the rent there, because guess what? The person paying the rent has fallen on hard times. Maybe they've lost their job or just lost hours, because the rents are quite frankly insane. And when you look at this chart from CIBC, it really tells the story of what's going on. So the average amount they're underwater, $300 a month, doesn't sound like a lot, but it is, and it adds up when your property taxes are increasing drastically, your maintenance and condo fees are going through the roof, and you've also got these other lenders, which is your MICs, your extremely risky lenders, which might I add have boomed during the past 3-4 years in Canada as Canadians opted more and more for riskier loans, which is just part of the cycle we're in. You see that time and time again, more and more risk that builds in the system. It's not surprising that those people are underwater even more. And when you look at the amount of market share that the Big Five took, they took most of it, which is very, very interesting when you consider the repo spikes that we've had. We had another repo spike that happened last week, a drastic one, and it keeps going up and down, but the repo trading volume has been insane since the end of May. That's not signaling good things about the banking system, primary dealers in particular, those systemic banks that I put on X a couple of weeks ago. Those are the ones that you really need to keep an eye on, and it's obvious that the lending is slowing between these financial institutions and also between the consumer. I'm hearing more and more reports on X about people being denied loans, lenders having a wait and see approach considering where the condo and housing market is in Canada and the bubble that we're in. So just take a listen to this, guys, for a second.
Toronto's stalled condo market.
Some analysts say it's the worst it's been in 30 years. As CTV's John Woodward...
Just think about that. The worst in 30 years. Well, if you go back that far, guess what was happening, guys? You had banks failing. You had lots of things going wrong. So a lot of people often say that, oh, it's the worst in 30 years. And we also know the yield curve was the most inverted it's been in 30 years, which proves our case even more than anything else anecdotal that this housing market is going to swing a wrecking ball through this economy. And it's already happening. It already is.
Sellers are losing money, and the news isn't good for potential buyers either.
It was a dream condo on the 37th floor in a building in the heart of downtown Toronto. Incredible views and modern fixtures, but it didn't help. Listings show it sold for $1.23 million, down about 21% since the purchase in 2021 for $1.55 million. That's about a $320,000 loss. And that was after 7 other realtors tried and failed, says realtor Rebecca Romeo.
So just think about that, guys. A 21% loss on this condo, and they're not even adjusting that loss for inflation. If you think about the amount of inflation we've had from 2021 to 2024, you're at least talking about 50%. And I would argue it's actually been way more than that. But for most people, their personal inflation rate is going to be between 30 and 50%. And if you do a budget year upon year, you can actually calculate this out and see how much things are rising in cost and how much you're falling behind. Your standard of living is decreasing essentially. So with that massive amount of inflation, it means the real loss adjusted for inflation, not the CPI, is beyond 50% likely. So it's just absolutely crazy when you really think about it this way, and people claim that the housing market is not collapsing. And I remember all these jesters on YouTube, many of the popular finance YouTubers in Canada, and I'm not going to name any of them, I'm not that sad, and I'm not going to take it down to that level, but so many of them have now converted over and said, yes, now the housing market is crashing, it's falling apart. But these were the same ones 3-4 years ago that were telling you, hey, the housing market's never going to crash because immigration, all these different things, it's just never going to crash. Low interest rates, immigration, never going to crash. And what we've seen since then is that narrative just completely fall apart. So builders now offering half-price mortgages, but still nobody is turning up for them. This is interesting. So countless builders are stuck with newly constructed homes they can't sell. It's not because their product isn't good, it's because many folks can't buy due to ridiculous unaffordability. And I would argue it's been like that for 5-7 years at least, but the difference is now the speculators have dropped out. At least they've dropped out in places like Toronto and Vancouver, and they've moved out to places like Calgary, Edmonton, Halifax, but eventually they'll get burnt. But all these speculators, this is their income, you know, trading assets essentially. Very, very risky business in a housing bubble. So when the bubble goes bad, they have to move somewhere else where prices are rising because that's the only skill set that they seem to have. And it's just crazy. But anyway, to snap potential buyers out of this trance, builders are dangling the carrot of mortgage incentives. Take Countrywide Homes. God, what a name considering the financial crisis. For example, it's pitching 3-year mortgage rates at just 2.34%. That's less than half the standard market rate. So it's basically a buy down. We have inventory that needs to be moved. We're essentially buying down the rate from the lender, and it helps. You get a lot of inquiries. I asked who the lender was and they wouldn't tell me. Surprise, surprise. Despite Countrywide's red hot financing promo, Marani, I'm probably pronouncing that wrong and butchering it, sorry, hasn't seen any takers. So even though they're taking rates down to 2.34%, guess what? Nobody's there. Nobody wants to buy. So what does that tell you about the narrative of interest rates dropping, housing market gonna boom? You're gonna have interest rates dropping, unemployment rising, and unemployment is gonna affect things way more because it affects everybody and everything in the economy. Because even if you're not unemployed directly, well, guess what? Somebody else is spending less money, and you get into this self-reinforcing loop essentially of more people becoming unemployed. They spend less money, economy gets worse, leads to more people becoming unemployed, and it goes round like that. So not good. And then Calgary Herald, rising home prices is top concern for buyers, not rising interest rates. If you read this article, it's linked in the description. It's actually rising prices because guess what? All the speculators have gone to places like Calgary and Edmonton now. And you've also got Bank of Canada seeing cutting rates faster after weak US job data that came. So BMO is saying the policy rate to reach 3.5% by January, 3% by mid-2025. And that's what BMO is saying. You know, after the market crash we had last week and the week before, I don't really think that they're going to be cutting rates that slowly. I think actually it's going to happen a lot faster. I mean, it's just this this narrative that they're just going to come in and cut rates really, really slowly, and we'll be going on that for 12, 18 months is just completely stupid. So markets are betting the Bank of Canada will cut at each of its remaining interest rate decisions this year, as the labor market in the US looks to be loosening faster than expected. The US unemployment rate unexpectedly rose to 4.3% on Friday, leading markets to price deeper cuts from the Federal Reserve in 2024. And I wouldn't say that they're actually thinking about the Bank of Canada's decision directly because of the US unemployment data. It's more of a case of how that affects the Canadian economy, the US being Canada's biggest trading partner. And obviously, if they're going into a recession, I mean, Canada's already in a recession, and it's going to be in like a real bad depression, obviously, when the US enters recession. I mean, it is just insane what's probably going to happen. So, though Governor Tiff McClem insists the Bank of Canada set policy independently, he can more comfortably lower borrowing costs if the country's biggest trading partner is about to join the global trend of cutting interest rates. And what's really interesting is obviously, again, that's assuming the Fed gets the soft landing right and they just begin to take those rates down really, really slowly. And I just think that's absolutely ridiculous. And as I've always said, even before interest rates start rising, the thing you need to look at is the bond market. That's really telling you the story of where interest rates are going, not your psychology, not what you think's going to happen, not what you want's going to happen, but take a look at that short end of the bond market. And the short end of the bond market is pricing in a hell of a lot of cuts, and the volatility has been all over the place, but still doesn't say a good thing. And when you talk about unemployment data, Shadow Stats has another amazing chart on this, which basically shows how the unemployment rate in the US is completely ridiculous. When you look at the Shadow Stats alternative, they're pegging unemployment at 25% in the United States. And if you use the U6 data here, it's around 6-7%, exactly like Canada, which is what you would kind of expect. And then they're also talking about, and I saw this, which I thought is hilarious, does Canada's housing market face an oversupply risk? Now that is coming into the mainstream media. I mean, you just cannot believe what's happening. If you followed this channel for the past 3 years, you know that we've been talking about this stuff for a long, long time. And to just see this go full cycle and people still look at these outlets and think, yeah, you know, these people, they seem to have an idea of what they're talking about. These mainstream economists seem to know what they're talking about. It's just completely ridiculous. I mean, we've constantly talked about how supply is not the only thing when it comes to the housing market. Obviously, if most of your supply is being absorbed by speculation, which is obvious, and that speculation dies out, you have a major problem. And that's the problem when you're in a huge housing bubble like Canada's in. So anyway, if you've enjoyed this video, I'd highly recommend that you check out this video about the unbelievable losses in this housing market. And if you're looking for a VPN to protect your privacy, go to expressvpn.com/marketmania, the most reliable VPN and the VPN that I use. Affiliate link in the description. I will see you in the next one. Take care.